I'm back for you guys. Sorry for the long absence. Okay, so Facebook is going public on May the 18th, which is next Friday. Okay, so a couple things about Facebook and why you want to get in. One thing, it's not the average IPO. Facebook is what you call the cream of the crop IPO. Most IPOs, they're new companies, they're not making money, they're struggling, they have to raise money to operate. That's not Facebook. Facebook is well established. They're in 170 countries. Their profits alone are 2010 they were 2 billion. 2011 they were 4.27 billion, and 2012 they're looking at 6 billion in profits. So the value of the company is going to come out around. The value of the company is going to be around 100 billion, which is unheard of for an IPO going public. So it's very well established. It's going to be steady. It's going to be solid. It will be volatile, but it'll be uh, whatever price it comes out. It'll be worth the shares, worth the price. It's going to probably open up around $35 a share. So um, we're thinking about it going to $75 within 9 months, and then next year upwards in the hundreds. Don't expect it to split because it's really cool. It's really cool now not to split, to let it run into the hundreds. So I figure it'll be competing with Apple and Google. The price range of Apple and Google around $600. Um, what else? Okay, so um, think about 30 days out after it opens. It's going to get a nice boost because new IPOs are marginable only after 30 days. So the first 30 days you have to pay cash. So after 30 days, figure, let's say the stock price moves to 60. Let's say it gets 20% bump. So let's say move to 72. So figure, get ready for that bump in 30 days because people are going to buy in shares because they can use their margin. Okay, the other thing about Facebook is it's going to be inducted into the S&P 500. Now people say, well, that doesn't matter. Who cares about the S&P 500? But there's mutual fund managers that account for like at least half of all the shares of the stock market, and a lot of them follow the S&P. So they're going to have to buy Facebook. Once it goes on the S&P, they're going to have to buy it even if they don't want to because they control the S&P. They have to buy the S&P. So because of the share sales and volume, Facebook will be inducted. People that run the S&P don't really care about the company as far as what they produce or what they uh, make. They just care about sales and profits. So Facebook will be in the top 500. Um, so figure it's going to open up at 35, so it's just going to go up from there. Think of it as a rare opportunity. So those are the two things. Now there's three ways to go in trading Facebook. I'll cover them briefly. Um, One is to buy the shares. Let's say you open up at 35, you buy some shares. You have to use cash right away, but then after 30 days, it's marginable. Um, think of selling at a profit. So let's say it hits 50. Think about selling and getting a profit. Let's say it hits 75, you can sell again. Let's say it hits 100, you sell again. So think about selling at the peaks and buy when it dips, when it settles. Okay. Um, next thing is to do the cover calls. The cover calls are probably the most valid strategy for Facebook, and cover call writing is probably arguably the best strategy on the stock market to make good money. What you're doing, you're buying 100 shares minimum. That's one contract, 100 shares, and then you're renting it out to the public. You're going to lease your shares out every month. You sell the call at the money or slightly higher. So the stock is 40. You're going to sell the 42.50. Let's go in fives. There might not be a 42.50. If the stock is 37.50, you're going to sell the 40. The stock is 42.50, you're going to sell the 45. If the stock is 48, you're going to sell the 50. Every 30 days you do this. And you're going to generate usually most covered call writing, you're getting 3 to 4% a month return. But for Facebook, because it's going to be so hot, you're going to get like 7 to 10% return. So figure like if the stocks are 40, you sell the cover call, you're going to get like 4 points, 44, right? That's 10% right there. Um, do that for 10 months, take 2 months off, and you're getting like 40% return a year. Um, sorry, that's 100% return a year, 10% per month. That's 40 points for Facebook. You're like doubling your money. It's a hard strategy to beat. So think of lots of 100,000. You know, so a lot of covered call writing on that one. It probably won't settle down as far as being so hot. Probably till next year, when the stock's into the hundreds, they're gonna figure, well, it might start basing. The calls might, calm down. Okay, the last strategy is the options. Now, the options are tricky because you can lose money. So you're looking at call options, of course, because the stock's going to go up. So think if the stock opens up at 35, say you get in by 40, you're going to sell, you're going to buy the 100 call options for January 2013, or the 110, or you're going to go out, 6 to 9 months or a year. That's the best way to cover a stock like this because we're figuring it's going to move good, steady. So if you're going to put like, by the way, don't put all your money in options, maybe like 5% or 10% because you can lose, okay? So you're going to buy like the 100 call, for example, and it's going to be like 30 cents. So that 100 call is going to be only good if the stock breaks $100 by next year, in this case, January 2013. If the stock goes like to 130, then that 30 call becomes $30. That's 100-fold. You see that? So $1,000 just went to 100,000. That's the best scenario. It might be less. It might be that it just breaks 110, say, so that 30-cent call becomes $10. It might not hit 100, and that's when you lose money. If it doesn't hit 100, your investment's gone, zero, zilch. So be prepared to take a loss. It's a risky strategy, but on certain companies like this, it could pan out. If you have like 10,000, I'd say, you have 5,000 just to hold the shares and do cover calls, and you can put maybe 1,000 or two in the options like that, and then put the rest in just holding the shares without selling cover calls. Because while cover calls are a good strategy, you can actually earn less if the shares just keep going up and up and up. In which case, the people holding the shares will actually make more money. But that's not guaranteed. The cover call money is guaranteed. Okay, so text me. Those of you who know my number, leave some comments here. See you around YouTube.